Welcome to Markets Now. I'm Michelle Rourke with Brian Doherty, Total Farm Marketing. Livestock futures ending mixed on Monday with the grains to the downside, and it was kind of another bloodbath, Brian, in the grains. So let's talk about soybeans first of all. Some new contract lows here off 25 to 28 cents. And really, there's just no threatening weather to stop this slide, is there?
Well, there isn't, and the old saying is markets often accelerate as they try and reach a top or bottom, and maybe that's what we're seeing here. Because what ends up, but why that happens, is because you've got those who are sellers in the futures market, and they're making money, so it's easier for them to kind of use what I call the house money to sell more. So you've got that. Two, you've got end users that just are not stepping up to the plate. They just don't fear any kind of concern from the supply side, so they continue to buy as needed. That's domestically and worldwide. And then thirdly, you took look at the tech side of it, and that's just looking at the charts themselves. When you have a sell-off like this, it's really challenging to find speculators and people who want to invest. They know it's good value, but they also know if they bought last week, the week before, it hasn't worked. So they get skittish. And so it just all of these things happen that propel a market downward. The backdrop of it right now, really, though, is just expectations for continued good crop ratings. And you've got a really good forecast that gets us through probably the next 10 to 15 days throughout the Midwest without any searing heat or real drought condition concerns.
And the same scenario is true here for the corn market. So is the trade basically thinking trend line or above yields at this point?
Well, it's interesting, the USDA, with all the sort of challenges that we had this spring with planting and late planting and maybe wet spots and those type of things, that shows up somewhere, but it didn't show up on the July yield estimate. So the market's got to go with what the yield estimate is from the USDA, I think, and at least that's the way it looks like to me. So you leave it at 181. We still have a what I would term an adequate carryout despite a supportive report. And the report basically reflected, and I think probably rightly so, that demand will be stronger. And the old economic rule is that when you have a lower price, quantity demand increases. So the USDA did push some more demand, and that's probably right. But it takes a while for that all to get into the marketplace. So while you may project stronger demand in the very near term, you still have not only a lot of supply, but the perception of adequate supply moving into the harvest season and beyond.
Yeah. So you take 100 million bushels of demand and take that off the balance sheets, but it's just not big enough here, especially when we still are working through some of these old crop inventories, right?
Yeah, it's been a problem that's plagued the market all year with these basis contracts. We saw that in the quarterly stocks report here recently. Farmer holdings are strong, and the general thought in the marketplace is, well, a farmer has to move corn out of his bin to make room for the upcoming crop, and then weather in July sort of sets the tone whether that upcoming crop is going to meet expectations or not. I would argue that June 15th is the true weather market, and your weather forecasts take you to the 1st of July, and then from there on out, it's every 2 weeks. And so the weather forecasts really look conducive for farmers to have good crops. In some areas, they're really going to be great crops. You've had some timely rains and good weather, and now it looks like most, if not all, of the pollination window will go off without a hitch.
And of course, we always look at analog years, lots of discussion about 2014. How much is this like 2014 in this corn market?
Well, it's very much like it, and it's very not. So let's remember 2014 was 10 years ago. Cost of production is significantly different. But when you overlay the charts, it's the same thing. The market started near $5 at the beginning of the year, just kept it hedging lower and edging lower and edging lower, very little bounce along the way, got to the 4th of July weekend, and then it just fell apart from there and got all the way down to 318 on the low before rebounding and getting back closer to $4 by December. But that was a really wicked and vicious ride. The crop was pretty doggone good that year. I had an opportunity to really travel the Midwest and crisscross it and see a lot of really good crop. I saw level fields, which is always potential in my book. So when you see that, now this year you got a big swath that is now sort of hidden because whatever corn's there is going to grow, nitrogen's kicking in. It may not look that great, but still the crop ratings will hold. So I don't think we had the same type of crop potential that we had in 2014 on a relative basis. But still, the USDA is projecting 181 bushel yield, and we haven't seen anybody deviate from that yet. Not even privates. I haven't seen anybody come in with a 175 or something like that. So if they are out there, nobody's paying much attention.
Yeah. It certainly does not help the corn market that the wheat market is going down as well. More new contract lows in Chicago today. And is this still report hangover? Are we still trying to work in those extra 100 million bushels that we put on the balance sheet?
It's report hangover, it's poor technicals, it's fund selling. I keep saying funds. It's just speculators who are looking at this going, well, I don't think the end user is going to step up here. That's what it's really a reflection of. The reports again sent a message to the community that buys that there's not a rush and not a hurry. And if there's not a rush and not a hurry and there's no urgency, and I always say if there's no pain, so until somebody starts to feel pain or they perceive pain, doing nothing has been a good strategy so far. It won't always be, but so far so good and rewarded again today if you're an end user. And if you're a speculator who's short, you had another good day. And it's easy to come into this thing and sell the next rally until the market really tells you otherwise.
Let's talk about live cattle. Do you think that we've put an intermediate top in there, even though we have futures at such a big discount to the cash trade here?
Well, I would say the market's acting like that from a personal perspective. Boy, it's really hard for me to think that this board isn't going to make a run here because the strength in cash and the premium of cash to the board. I do often have to remind myself, though, that the board price is the expected price, let's say in August or October, not doesn't have to match today's cash price, and those two have a tendency to converge. My best guess is you're going to see some weakness in cash. You're going to see the board recover, and there's probably a middle ground in there somewhere. But boy, the speculative interest has been really tepid, and we had some good strength, and then they backed out right away. So I think they're willing to exit quickly. I think the underlying root of all of this kind of conservative futures market is just a general concern that the economy just isn't going to develop a new demand market at higher prices. And sticky inflation continues to suggest that is a concern. And as I've said before, I can't see where we're going to build new avenues of demand, both domestically or worldwide, at high prices and limited supply. So you'll have a good firm marketplace as long as the people who can afford beef can afford it. Uh, eh, but you're not going to develop new demand markets. So I think that's why we had that big run last fall up to the 200 area, and then cash has been strong. But I think the board has been just hesitant to follow, and I think that's a good rational reason why they don't expect cash to hold.
Yeah. And you do have the seasonals working against you right now. Isn't that right?
That is correct. Typically, once you get past this 4th of July, you've got all your kind of big summer purchases and grilling, and then you typically have more supplies. And as you head toward fall, if there is a kind of a window in the year where you had to say, well, where do prices usually bottom? It's usually toward the fall, and where they peak, it's usually in that March April window. So that's another sort of self-fulfilling thing that might be ahead of us is that the traders, they know cattle are high priced. They may not just be willing to chase it. We saw where the market had a nice upturn here a couple of weeks ago into last week, and then it quickly sold off. Very cautious on buying into strength.
No doubt. All right. Thanks for joining us, Brian Doherty with Total Farm Marketing. That is Markets Now.